So you have a property that you have just refurbished and you have costs associated with that refurbishment, but how can it help you to reduce your tax liability? Well, check out this video as Louise and I go through those details. Okay, so this is from Jubilee Property Investment Limited.
Hello,
that
Jubilee.
Is actually their that is their name on YouTube. So hello there.
Hello.
The question was set around about my accountant in regards to refurbishment costs. We bought a property through a limited company. Now we are going to be talking, if you can hold that piece of paper up for everyone on Clubhouse listening in.
I'm so sorry, team. If you can't see this is property page 1 of a tax return, personal tax return, property page 2 of a tax return. And my life tonight is most likely going to revolve around these, but I'm guessing that Jubilee Property has possibly a very helpful question that, quite frankly, it doesn't matter what tax return is going on. You just need to understand the principles.
Well, I think the audience really wants to know what that question is.
Go for it.
Right, brilliant. It is about limited company, but we'll ignore that because the principles works for self-assessment as well as limited company.
Yes.
Right. So with that in mind, what they've said is that they haven't had a refurbishment, which it had a revenue cost, which he believed, of renewed and replacement items. The accountant is, however, saying that 18k is capital, as we did not have any rental income first before the refurbishment takes place. So I'm going to let you, because it's your show, Louise, so take it away.
Take it away. Okay, I'm not going to do this in the method of mime. You'll be very pleased to hear, everybody. I'm actually going to do my best to answer. So let me just recap over the question. The question was, I have a property, doesn't matter whether it's in your personal name or limited company for the purposes of answering this question. I have a property, it's a rental property. I have bought it, I have refurbished it, I've done work to it, and I'm being told by my current accountant that maybe all or some of that work is not tax deductible because it's classified as a capital expense, not a revenue expense. That's a really, really interesting question. Excuse me. I would say that there's probably an element of truth to what your accountant is saying and an element of perhaps misunderstanding. And what I mean by that is that just because you are refurbishing it for you to use in your business, whether that be in your personal name or limited company or even partnership, just because you're refurbishing it to a standard that is akin or aligned to the rest of how you run your other property business activities, doesn't necessarily force it to be capital. There are typically a couple of occasions when an item is capital and not revenue, and therefore won't help minimize your personal tax position. The first example is typically when you are completing a piece of enhancement to the property. So you are building a bedroom in the loft for the first time. You're extending the property and adding on extra rooms to the property that were not there before. Those are enhancement in nature and will therefore be capital. And the only time typically that you'll be in a position on a residential property to claim the expenses to help minimize your tax is at the point of sale, when you'll use them to help minimize your capital gains tax. The second example of when you might hit capital expenses is if you take on a property that, quite frankly, is not livable in. It is so distressed, you've got to do work to it in order for it to be of a lettable standard, even a basic lettable standard. And such expenses to deal with such distressed natures of property, unfortunately, are capital in nature. So again, it may be, to your eyes and my eyes, a repair. So you're repairing perhaps a roof that's already there. You're repairing a kitchen that's already there. If it is literally unlivable, then I'm afraid it is going to be of a capital nature. Pretty much almost every other expense you might incur on having a property brought to a standard you wish to rent it to is going to be revenue. And I'm going to ask you to write this down now. I want you to write down the word PIM, P for Papa, I for Igloo, M for Mother, 2068. Now, this is a property income manual within HMRC's rules, and it lists out for you beautifully about 20 or so different types of expenses that will help you understand what is revenue expense. Get that pen ready again, because I've got another one for you. PIM 2030. Now, PIM 2030 is again a lovely help sheet from HMRC that brings to life when an item is capital and not revenue. So, Jubilee, I think you might want to share PIM 2030 with your current accountant to discuss and debate which elements of your cost are indeed capital and which elements of your cost are revenue. So I'm hopeful that might help.
Could you show, because this is about tax returns, we need to be really focused tonight on where that is on your tax return. So if you could show everyone, that'd be fantastic.
Okay, so I'm going to look at the residential property page. So this is page 2, and I'm so sorry if you can't see this. Can you see at the bottom?
Yeah, we could just see
that.
It
says UKP2. So this is the page on which you put your residential property
Just for
incomes.
clarity, what page is that? What box number, sorry?
Well, I'm going to talk about boxes in a second, because there's a lot of boxes on this page.
Because we're accountants, we love boxes.
We do. But typically, a repair, replace, renew expense falls in this property expenses box, box 25. It's where I'm kind of showing, I'm going to move my other hand down. It's where I'm showing my finger here. And it's here that you would capture the expenses to do with repair, replace, and renew. And those 3 words are words that you probably are very familiar with if you're already a client of ours, or perhaps you've watched some of Simon's other videos. That is the box of delight. That is where you capture your revenue expenses to help minimize your profits, to help mitigate your tax.
Now, just answer, and aside from that, there's one more question I want to ask you from a tax return perspective. But anyone listening from a property tax perspective, one and the same, but I always have to say that there's a differentiation from tax advice and tax returns, and that is theoretical of the property tax. And what I mean by that is when we think about buy-to-let mortgages, one of the conditions for you to get a buy-to-let mortgage is that it's in a lettable condition. And if you look at that very page that I've put a link, because Louise mentioned the link, so I've put that on the chat box. But if you look at that manual, it will say quite clearly that you can have a revenue expense if the property is in a lettable condition. Well, if you've got a property with a buy-to-let mortgage that also is in a lettable condition, there's no room for any accountant to say, well, I'm going to dismiss this as capital. It just doesn't make sense.
There is a final thing that I'm just going to mention, if I may.
No, because you're going to really steal my thunder. You need to wait. I'm sorry. It's your show. It is your show, but really,
you heard it here, folks.
There is one question I have. So, in terms of people that have a self-assessment tax return, and again, if you could just hold that up for a second, because people that might use these sheets, I'm just going to get it ready for Louise to see the screen itself. But people using these boxes, the one thing I would say is make sure that you have a receipt. Now, if you have, and we talked about this earlier, if you have a receipt from a builder that says refurbishment costs £30,000 with no description at all, tell us some best practice about what the invoice should look like and the details contained within that invoice.
Well, firstly, there should be an invoice, or there should be some form of receipt to validate that you genuinely have had that expense. And sorry, guys, you probably half already know this, but you've got to hold on to those receipts. And I would argue, hold on to them for about 7 years after the tax year in which they actually fall due, because HMRC could ask you for them. And if you don't have them and they open an inquiry, you will be in a really bad spot in terms of being able to explain how you've arrived at your expenses. But if you do have an expense and you have, as I say, a receipt, don't allow the supplier to control what is said, or rather what is not said on the receipt. So you want that receipt as much as you can get itemized, particularly if there's an element of capital and an element of revenue expense on there. You must have those two segregated so that you can see what bits are revenue, what bits are capital. And an invoice should have a small number of things on it. So without boring you to death, the first thing it should have on it is, of course, your details. So which property were they working on, maybe even which room, if it's divided up into, for example, a HMO set of rooms or mini flats. You need to have the date as to when the invoice was released. You need to have it actually say it is an invoice. You need to be able to see the expense, both in terms of if it's VAT, you need the VAT on there as well. You need the VAT registration number of the supplier. You need the name of the supplier on there. So just as a small number of key points, you really need those points on. I have seen, and it happened to a client of mine not so long ago, that they incurred an invoice for approximately, I think it was £20,000 for an improvement to their property. It was broadly described as, and it was pretty much, it said on it, fix new kitchen. What it should have said was remove old kitchen, install replacement kitchen. And because it didn't have those words, the HMRC agent who actually oversaw the investigation, because it was as an investigation that this came up, decided that they would not allow the expense as a revenue expense, and said the only thing that their client could do, if they couldn't get hold of the builder and get the builder to reissue a corrected invoice, was to hold that invoice for capital expense. Well, that individual at the time was incurring 40% tax, which meant that a £20,000 expense had just added approximately £8,000 worth of tax to their personal tax return, just because the invoice didn't say what it should. And that's something I wouldn't want any of you guys to fall into the trap of. And there may be invoices already that you're at a stage now, sadly, you're not going to get them corrected. Maybe the builder or whomever it was that supplied has gone out of business, or you're no longer in contact with them. But for future, please be very much in control of what those receipts are saying. If you're not happy with what the invoice or receipt explains or describes, discuss it with the supplier and get it corrected.
I think the other side of that is, if you are using a bank account, which I think you should do, is make sure that it is going out of your property bank account, so you can match the expense out of the bank account itself with the invoice, with the item either in Xero, QuickBooks, or some other bookkeeping system, that you can tie all three together. Because if you can get to a stage whereby, sorry, Louise, but if you have a stage whereby you have a tax return, and then behind that you have an Excel report or a Xero report or QuickBooks report that marries each of these numbers, and then invoices behind that, to be fair, that's a bit boring sound like, because it's an auditor's role to do that. But it would be so solid as a tax return, because no one could raise any questions. So if you want to be robust and strong about what you're doing, make sure that the receipt is descriptive, that it does use the words repair, replace, renew, as opposed to, as Louise said, renew. You don't want new, you want renew, and replace, then replace, renew,
replaster, repaint. There's a lot of re's here, and that's what you want if you want to get it under revenue.
And to be honest, this is a sermon. This is a religious education, as well as a tax. I did tell you his jokes are bad tonight. Sermon. So
mind you, they're bad all the time. Anyway, moving on. One last thing before he so interrupted me. What I did want to say to you is that sometimes people get a little bit concerned or confused over, well, I am replacing something, but actually it's an enhancement. You told me, Louise, enhancements are capital in nature. Well, I'm replacing a single glazed window with a double glazed window. I'm replacing lead pipework with latest plastic pipework. Technically speaking, it would be pretty impossible to correct and replace something with the same item as prior if the laws around minimum standards have changed, or indeed standard practices change. So standard practice these days is that it's double glazed window. Standard practice is that it's plastic UPVC push fit pipes. You can tell I'm no plumber. These things therefore mean that although they technically arguably could be an enhancement, they're actually not, they're a replacement, and you're allowed to have them under replacement and therefore revenue, not capital enhancement. So that was my final comment.
There are many live events that you can register for free. There are 4 events that's showing: HK to UK to help people move from Hong Kong to the UK, the Property Expert Panel. If you're a property investor or property developer, this will be very useful for you. Tax Q&A, if you want to ask proactive tax questions in regards to structures and how to mitigate tax in the future. And finally, UK tax return Q&A, as it says, to deal with questions in relation to your tax returns before you submit it to HMRC. Don't forget that these events are live and will be shown on YouTube the day after. So why not register today, start saving tax tomorrow.